Hi, this is Dr. Roger Hannegriff, and welcome to this video about an introduction to the income statement. Now, I want to start it off with a famous quote. A great agricultural educator, Booker T. Washington, around 1890s to 1915 era, really kind of summed it up best. And his quote, one of the quotes he has, is at the bottom of education, at the bottom of politics, even at the bottom of religion, there is a race. So at the bottom, these basic things, but there's always a race for economic independence. And economic independence really can be also connected to financial independence. And so in our class here, or in this topic, I'm talking about something called the income statement. And that is a core financial statement that really sums up economic independence. So what a great educator talked about is something still relevant to today. Now, let's review a little bit. Before we talk about the income statement, let's review a little bit about something called the balance sheet, because that's really a core financial statement as well. And it has talked about that our records can be organized into the kind of assets that we have. So these are the things that we own. And we own those through maybe some liability actions. So this would be debts that we have and something called equity. So just to review, which is really money that we have earned. And that equity is called retained earnings. Again, that's something I already talked about. And that retained earnings is what the income statement is all about. So as we've already talked, hopefully you've already looked at it, the balance sheet is something that's core to our business, and it talks really about what we have, what we might owe, what we've earned, what people have invested. It gets kind of complicated, but really what we're earning is the goal, and that earning is illustrated in the income statement. Now, a couple things about the income statement is it is always represented a set period of time. Typically that time is a year or less. You could also look at an income statement over several years, but it will always be summarized in a year or less. So it really doesn't make sense to say, our decade of income is all together. That's really kind of a silly way to look at it. But you could look at a particular year, 1, 2, 3, 4, 5, and you would have columns of income statements. Income statements aren't like a balance sheet. A balance sheet represents the beginning of time all the way till any day you look. It's a snapshot, covers the whole history. An income statement is always broken into set periods of time. And that's because you're looking at a window of time, and any of those captured times, quarters, months, years, are all summarized into those values that represent that set period of time, and they're dropped right in the balance sheet under retained earnings. And so that's where all of that information goes. But let's talk about what is the income statement. Now, it's organized in lots of different ways. It depends on really the business. There's a couple of ways income statements are also organized, and that is a cash method or an accrual method. So let me talk about those really quick. So let's talk about methods. That's an M here. Methods of the income statement. So kind of a quick review here. One of those is based on a cash method, and that means every time that you get money in, that is a good thing, and then money out would be a bad thing. So that's kind of like income and expenses. So you keep up with an income statement based on when money comes in and when money comes out. However, that's not the best way to look at an income statement, because what you're missing is, well, what about other items? Like, for example, if I'm a farmer and I have got a set of calves that I did not sell last year, I decided to keep those back, put them on a wheat pasture, grow them up a little bit more. I might have even decided to take them all the way to the processor and sell custom beef. Well, if I'm a rancher, that means that I didn't get that money in at that period of time. I didn't sell those calves. I kept them. So they grew inventory for me, and I haven't sold them yet, but I will. And so you can see that if you did the cash method of an income statement, it would look like you never sold any calves. But they're actually in a wheat pasture growing up, and I'm going to sell them as custom grass-fed beef. I'm going to sell them by the cut, sell them by the head. However, it's just at this period of time, I didn't get any money in. So if you looked at an income statement on the cash method, you would not see those calves at all, and that would kind of make you look like the business hadn't made any money. So there's another way you do these records, and that is an accrual basis, or an accrual, I should say, probably the same method. An accrual method adjusts for things like accounts receivable or accounts payable, meaning someone owes us money and they hadn't paid us yet. So those are different ways you would record income. And it's not really about money in, it's about actual transactions. Another one that I mentioned a while ago as an example is inventory. That is another accrual adjustment. So an income statement could be kept on a cash method or an accrual method, but the accrual method is the one that gives us the most accurate information. So I'm going to outline an accrual method balance sheet kind of as a template of what you would see. Now we'll get into some examples later, but just what does an income statement look like, and maybe even follow along with some examples that you might see there. And there's a lot of ways that this gets labeled. Again, I'm going to illustrate to you what I think is the kind of the most common income statement structure, and then we can see what changes we might see as we go through. So the first thing is, on an income statement, you're always going to have a section right at the top that's all about income, like where do you get your money? And so you're going to have normal sales items, like you could have sales of hay. You could also have sales of calves. So you could have lots of normal, I'm going to put this over here, normal income. Okay? So normal income. Now this normal income could continue to list other items, as you would imagine. So it would be like, you know, you had 50,000 of hay sales, and you had 100,000 of calf sales, and you could keep going. Now, in the income section, you could have also a section that is an accrual area called inventory adjustments. And so inventory adjustments would be focusing on, did our inventory go up or did our inventory go down? Well, if your inventory went up, that means you did not get a chance to sell them, so that increase, not the total value, just the increase, because remember the income statement's a set period of time. So if this was, let's say, 2020 year, and 2019 you had an inventory of, let's say, $50,000 worth of calves out there. And then, of course, you sold them in this year. They're part of that sales. It's already there. But if your inventory started out at $50,000 in 2019 to 2020, so 2020 began at $50,000, and if you ended the year with $75,000 worth of inventory, then that would be a $25,000 adjustment that's positive. And that shows that our inventory went up. So that's not captured in sales. So the $50,000 we began with, we ended with $75,000. Let's write that down here. $50,000 is going to be our beginning, but we ended with $75,000. So therefore, that's why we have a $25,000 plus in our inventory adjustment. And so if you get this here at the bottom, you would have something like gross sales or gross income. Some idea that we have, and if we add these all up, we're talking about 50,000, 150,000, and 25 more thousand. So you're talking about $175,000 gross income. And so that is a good way to look at the first section of the income statement called income. Now there's another section here of the income statement, and it starts to get into the other side of the income statement or the net income statement. There's lots of ways it's described. Profit and loss is another way this is described. But you've got income, and of course, what's the opposite of income? You have expenses. Now, expenses can be broken out in a couple of ways, and I'm going to look at some expenses broken out into a way that I think makes the most sense for us here, and that is going to be something called cost of goods, I should say, plural, sold. So cost of goods sold is going to be items that directly relate to income. So if we had to purchase the hay to turn around and resell, then that would be a cost of goods sold. And so I'm going to put that we didn't raise the hay, we must have purchased the hay. So hay purchases, and I'm going to put $20,000 here on what we actually bought to then turn around and resell, which you can see right away we sold 50,000, we bought 20, so that shows you a little bit about markup. Now inventory again would be a thing that might play with that, but we didn't worry about, we just looked at inventory on our cattle. The calves that we actually raised, we may want to put in there direct cow cost, feed, vet medicine, that kind of stuff that it takes to actually get these. So I might even look at feed here as a cost of goods sold, and I might say feed is, let's say it's $10,000. So cost of goods sold is a section that is very common, and I wanted to actually outline it. Let's stop right there. You could have more of those in cost of goods sold, and you're going to end up with a total cost of goods sold, and I'm going to have, in this case, 30,000 as my total. Now what I like about cost of goods sold is you've got income, the direct cost of goods sold, that creates something called gross margin. Now gross margin is going to be taking away what our gross sales are minus our cost of goods sold. So in this case that would be what, $145,000? And gross margin is something that we always want to look at in a business. If you do, gross margin, by the way, a little highlight here, you can write in your notes, gross margin is always positive. Or, I should say, always should be positive. If you've got a negative gross margin, that means the more stuff you sell, the more it costs you even more than that. That's a bad idea. So you're in a bad situation if gross margin is negative. That means you really need to stop selling things because you're losing more and more money. Most businesses that operate income minus cost of goods sold will be positive. That contributes to the rest of the business. And so that's what we're going to kind of do, is try to keep making these notes. I've got a little bit of room here left, so let's see if we can wrap it up. After cost of goods sold, you really have something called operating expenses. So I'm going to list some of those out, and that would be things like repairs, labor. You could keep going with these examples. And so let's just say that all of those add together to $45,000. And so finally the bottom line of this is net income. And so in this case, that is $100,000 net income. So running out of room there on the board here. Hopefully that shows up for you well. So let's review a little bit before we leave here that that the income statement is connected into the balance sheet as part of retained earnings. The income statement has a couple of areas that are always listed that are important to isolate here, and that is that you've always got an income section. And then that income section, if we do accrual accounting, you end up with adjustments. Those adjustments kind of tell us if our income really should be booked a little higher or a little lower. And all of that is part of what is illustrated in the balance sheet too. All right, after that we end up with something called gross income, which just totals that up. The next thing is on our cost of goods sold, or we start to get into expenses, and that's one area is cost of goods sold. If you have cost of goods sold, you have also a gross margin. Another expense area is operating expenses, which is all the rest of the expenses it takes to get this income made. And the bottom line number we're looking for is net income, and I've got some examples here on money that help us go through that. And so that is the structure of the income statement. It is organized in a cash method or an accrual method, but which method is the best for accurate information to run our business? That's an accrual method. That means we do some adjustments of inventory. I did not talk about adjustments of expenses, but it would be the exact same concept. So you have kind of that connection either way. And then all of this, once again, income statement tells you about profit, net income. That's what we want. Now, we want net income to be positive as well, but as you go up through here, maybe at a particular point in time, our ability to sell profitable products is not that high. So we might not sell income as high as we'd like. We might still be spending quite a bit of money on it, It still makes us a little gross margin, which is good, but when you factor in labor and rent and machinery depreciation, all of those other expenses that we'll talk more about later, then you end up with a net income that's not positive. It could be negative. But we can operate like that as long as we have a plan on how to improve the value here. As long as gross margin's positive, that's a key thing to pull out of here. But all of this flows through to how we keep the records, and all of that flows through to what gets reported in our balance sheet. And that is why an income statement is very important. It actually helps illustrate what our business has grown to be worth. Remember, it's also for a set period of time. It's not forever like the balance sheet. You keep getting snapshots of income for whatever your management window is, like a year or a quarter. And so those are pretty much the values, less than a year. All right, hopefully this video helps you understand better the income statement, and hopefully it also connects to our beginning quote here. How do you become financially independent or financially, economically independent? And that's through financially independence. And the income statement is what kind of gets us to that bottom line, and we want that to grow and be positive. In fact, the larger it is, the better it is. That large income grows the equity portion of your balance sheet, which is also another way to illustrate growth. All right, hopefully this video helps you better understand the income statement and its structure. Thanks.